The exchange margin required to execute an option strategy does not represent your actual risk. Conflating broker margin with true structural risk is a mathematical error. When a black swan event hits, this misunderstanding leads directly to devastating account blowups. Many retail traders fall into a very specific trap. They pledge their long-term investment portfolio, stocks, mutual funds, or ETFs, and receive a 90% margin benefit. Seeing that massive margin sitting in their account creates a dangerous illusion of liquidity, compelling them to trade simply to utilize it. To trade sustainably, we have to discard default broker margin limits. Instead, we are going to build a strictly defined position sizing framework by reverse calculating our leverage straight from our notional exposure. Large drawdowns stem from a gap in understanding systemic leverage, occurring even when the underlying strategy is technically sound. The first step is separating your total net worth from the capital you consciously allocate for trading. You cannot treat them as interchangeable pools of money. In the Indian market, regulatory constraints enforce strict limits. If you want to take positional, overnight trades in the derivative segment, up to 50% of your margin must come directly from cash or cash equivalents. That immediately caps how much of your pledged portfolio you can actually deploy. Looking at this breakdown, suppose you have a total pledged portfolio of 50 lakhs, yielding 45 lakhs in margin, but you only have 5 lakhs in free cash. Because of the cash requirement, your ability to take positional overnight trades is severely restricted. Back-tested drawdowns usually represent idealized conditions with perfect execution. In reality, market noise and execution slippage mean your live results will inevitably drift from the historical average. Professional frameworks double the historical max drawdown to account for real-world friction. A 20,000 rupee back-tested loss becomes a 40,000 rupee assumed drawdown. This 20% rule sets a limit. With 5 lakhs cash to absorb losses, deployed margin cannot exceed 25 lakhs. Your trading capacity is calculated backward from your available cash buffer and your assumed drawdown. It is never calculated forward based on the total margin your broker gives you. Let's apply this logic to one of the most common structures traded today, the intraday at-the-money short straddle. To gauge risk, calculate total underlying exposure. Multiply index spot price, lot size, option delta, and number of legs. Using Nifty, 25,500 spot times 65 lot size times 0.5 delta times 2 legs. That yields a total systemic exposure of 16.6 lakh rupees per lot. Next, we define the capital we must allocate to this single lot. Add the 3.25 lakh exchange margin to our 40,000 rupee drawdown buffer, giving a baseline allocation of 3.65 lakhs per lot. By dividing our 16.6 lakh notional exposure by our 3.65 lakh capital allocation, we reveal our true structural leverage. In this scenario, we are trading at 4.5 times leverage. If you want to decrease that leverage to a flat 4x, you don't change the trade. You simply allocate more of your cash buffer, specifically 4.15 lakhs, to that single straddle. Notional exposure is the fixed anchor. It is the only mathematical constant you can use to deliberately dial your leverage up or down. Retail traders frequently try to manipulate this math by buying incredibly cheap, deep out-of-the-money options, say around 3 rupees each, alongside their core short straddle. They do this to trigger margin benefits. Adding these wings tricks the broker's system into recognizing the position as hedged, dropping the required margin down to roughly 2 lakhs per lot. Look at the structural reality. The required capital foundation shrinks dramatically on the right, but the massive 16.6 lakh notional exposure block hovering above remains unchanged. Supporting that exact exposure with only 2 lakhs capital artificially inflates your systemic leverage to over 8 times. At 8x leverage, tail risk is magnified. A sudden market gap up will tear through your account equity long before those cheap out-of-the-money options provide protection. OTM margin relief functions as a leverage manipulation tool. Attempting to extract extra positions from a limited capital base this way frequently invites systemic ruin. Market environments shift. Expanding volatility requires adjusting position sizes to ensure our math holds together. For dynamic and discretionary systems, the rule is strict. Your absolute rupee loss per trade must remain perfectly constant, regardless of market conditions. This visualization tracks price action against position sizing. As the average true range expands and stop-loss distances widen on the top chart, the traded lot quantities on the bottom chart must shrink proportionately. In normal volatility environments, a system might dictate trading 10 lots with a 100-point stop-loss. That creates a total absolute risk of 65,000 rupees for that specific trade. Then, volatility spikes. The required stop-loss distance doubles to 200 points. To maintain control, you cut your position size in half, from 10 lots down to 5 lots. Your stop-loss widened, but your maximum exposure remains locked at exactly 65,000 rupees. Scaling down dynamically keeps your drawdowns within the mathematical boundaries we set earlier. It prevents you from abandoning a historically profitable strategy during a period of high volatility. In a book called The Zurich Axioms, author Max Gunther details the rules used by historically successful Swiss speculators to manage capital. The foundational principle of these institutions is clear. Professionals do not attempt to avoid risk entirely. Their sole focus is avoiding absolute ruin. Think of leverage like crossing a river. Having zero leverage is standing safely on the bank. You will never drown, but you will also never cross to the other side. Over-leveraging is attempting to sprint across the water when the river is flooding. A single slip means you are swept away immediately. Optimal leverage is stepping into the water only when the current is below your knees. It ensures that when conditions suddenly change, you can keep your footing. This requires strict discipline. Calculate exposure from the notional value. Reject artificial margin traps. Enforce constant absolute risk, dynamically based on market volatility. Conservative leverage ensures long-term survival, providing the runway for a strategy's mathematical expectancy to eventually manifest.